Okay, good morning, everyone. Hope you had a great first day. Welcome to day two. The over-the-top conversation has been a big one with content creators and distributors now for a while. And our guest, Spencer Wang, is really a specialist on over-the-top, and that's why it's called Changing the Game. So without further ado, I would like to introduce and thank him for coming, Spencer Wang from Credit Suisse. Thank you, everybody. Spencer.
Great, thank you. Thanks, Rick, and thanks for having me here at NATPE in 2012. So good morning, everybody. I'm Spencer Wang, and I head up the Internet and Media Equity Research team at Credit Suisse, which is a global investment bank. I oversee a team of about 15 research professionals that cover a wide array of TMT stocks, and I also personally cover the large-cap U.S. entertainment conglomerates and the large-cap Internet sector as well. Let's see if this works. Great. So the reason we cover the Internet and media sector together is because we do think that there is a growing amount of convergence between these two industries, and that it's really important to be able to see the forest through the trees. So as this slide highlights, and as you all know, broadband penetration continues to grow, and this has resulted in a host of new entrants in the three key parts of the entertainment supply chain: content creation, aggregation, and distribution. And we think this has really important implications for the future of the video business. So I'm going to talk today about what I think is one of the most interesting themes that touches both sectors, which is the growth of over-the-top, or OTT for short, video services like Netflix, YouTube, and Hulu, among many others. So we've been studying this theme for about 2 years now and have done a lot of research on this, so I'm really excited to share our thoughts with you about this. I'm going to talk specifically about how it could impact the traditional television ecosystem as we lay it out here for you on this slide. Moving on to the next slide, this is conceptually how the industry structure could increasingly look in an over-the-top scenario with a host of new aggregators like Netflix, Apple, Amazon, and Google, while some existing content creators and aggregators could also use the internet to go, quote-unquote, direct-to-consumer. So in this type of scenario, some distribution platforms like satellite and TV stations could become marginalized, while some distributors like cable and telco fiber could ultimately become more and more like broadband delivery systems. So in a nutshell, we're concerned that the emergence of lower-cost internet-delivered video streaming services could result in some cord cutting and a shrinking pay TV universe. And to be clear, we're not here to tell you that it's all over, but rather that the pay TV business tomorrow could be smaller than what it is today. And in fact, we think that you're actually seeing some early signs of this already. For example, pay TV subscribers in the U.S. across cable, telco, and satellite declined for the first time in U.S. history in the second quarter of 2010. And since then, pay TV customers have declined sequentially in 4 out of the past 6 quarters. There's obviously seasonality in the pay TV business, so we do strip that out by looking at the growth rate in multi-channel homes on a year-over-year basis. As you can see here, the picture isn't that much better. Pay TV subscriber growth has decelerated significantly and is now effectively zero. So I know a lot of people argue that this is just the impact of a weak housing market and that we're probably being overly sensationalistic. But if you actually study and believe the U.S. Census data on occupied homes, U.S. homes are actually growing faster than pay TV homes. And this is resulting in declining penetration for multi-channel video, which has fallen by about 2 percentage points from its peak of about 87% 2 years ago. In fact, we show you here that the correlation or the relationship between housing growth from the years 2005 to 2008 used to be quite high. The R-squared was historically about 82%. But in the past 2 years, as you add the new data in, what you find is that this relationship is actually breaking down, and that correlation is now only about 45%. So what's going on? Well, I'm going to make the case today, hopefully somewhat convincingly, that the pay TV business is exposed to the disruptive technology from the over-the-top video services, and we're going to talk about this by applying the Innovator's Dilemma analytical framework. So to take a step back, as we think about the evolution of the U.S. paid television business, our assessment is that there has been a very heavy emphasis around what's been called sustaining technologies, basically modest incremental improvements, which in the case of pay TV has manifested itself in the form of more channels. At the dawn of the industry in the 1970s, as many of you know, one of the core benefits of paid television was the ability to offer consumers more viewing choices in the form of new channels that complemented a very limited number of broadcast networks back then. Since then, the industry has continued along this path with satellite technology, digital cable, video on demand, high def, and now 3D, all essentially augmenting the number of channels and choices available to U.S. households. Because of this, the average number of TV channels receivable in the year 2010 was 135. That's more than double the 63 that were receivable in the year 2000. The challenge, though, is that the number of channels that people actually view hasn't actually changed that much. The average number of channels, for example, viewed per adult per week in 2010 was only 16, and that was up from only about 11 in the year 2000. So this dynamic is what leads to common cliches and common refrains from the consumer, like 500 channels and there's nothing on, or why do I pay for channels that I don't watch? At the same time, the cost to the end consumer, as measured by paid television ARPU, has consistently increased. As of 2010, the blended paid television ARPU approached $75 a month, which represents a 7% compound annual increase since 1995. In comparison, pay TV ARPU growth has outpaced growth in overall inflation as measured by CPI or core CPI in 15 of the past 16 years. And this, in a way, is reducing pay television's affordability to the average American. Therefore, while many people in the industry argue that the cost per channel delivered has been declining, which in fact is very true, what you find is that the cost per channel viewed has actually been rising, and that the gap between the two metrics has actually been growing, as we show you on this chart here. So this implies that the utility of pay television is declining. So at the same time as you have all these dynamics that I just talked to you about, which is an eroding value proposition, we also have today the emergence of streaming services which are lower cost. And here we just use Netflix, the clear leader in streaming services, to illustrate the basic value proposition. With Netflix, for as little as $8 a month and a broadband connection, you can watch movies in the premium window from Disney, Sony, Paramount, Lionsgate, and MGM, as well as older library titles. On the television side, Netflix offers a huge amount of prior season television episodes from a variety of different networks and studios. So, in our view, low-cost subscription streaming services have a lot of the hallmarks of what's called disruptive technology. Historically, in the early stages, disruptive technology actually underperforms mainstream products. And clearly, what you get from streaming services today is nowhere near as robust as what you can get from traditional pay television distributors. But these services do have other features that we think consumers on the fringe actually do value, which typically center around three characteristics for disruptive technologies. Number one, low price. Number two, convenience. And number three, simplicity. First, on price, as I mentioned to you, at $8 a month, it's a cheaper alternative, and that's even when you factor in the cost of naked broadband. Second, there's increased convenience in the form of multi-platform access. As you know, subscribers can access these streaming services on demand through internet-connected television sets, mobile devices, laptops, PCs, etc. And thirdly, with simplicity, their UI is more seamless, and some of them also have recommendation engines, which helps increase the utility of the content that they have acquired. In comparison, existing pay television operators are still struggling with clunkier, grid-based, Excel-looking type of interactive programming guides. So our concern is that these over-the-top services over time could increasingly be viewed as a substitute for traditional paid TV. I know a lot of you would say that the content, again, on Netflix or Hulu or YouTube isn't compelling enough. And to address this, we just talk about and introduce the concept of good enough. And so this school of thought argues that what consumers value, or what some consumers value, is changing, with low price, simplicity, and convenience growing in importance relative to other attributes like an abundance of features and raw performance. And while good enough may not be for everybody, there may be some segment of the market that may trade the latter set of attributes for the former. And we've seen this with other different product types, and we've listed a couple examples for you here on this slide. Skype, obviously, for voice, or netbooks or tablets for computing. So the idea that streaming services aren't a perfect substitute for paid TV may be true, but it may ultimately be the right answer to the wrong question. The real question is, do they have enough content to satisfy what people want or demand? And as this slide here shows, that there's a very wide dispersion in TV viewing habits in the US. For example, the average adult consumes slightly more than 3 hours of television per day. But this massive, very wide band of viewership. And if you segment it by quintile or 20% buckets, the heaviest quintile viewer in the US watches 7.5 hours of TV a day. That's a pretty staggering number. But the lowest quintile consumes only half an hour of television a day. So we don't think it's that far-fetched to believe that streaming services may acquire enough content to satisfy that 20% of the population that watches on average 30 minutes of TV daily. More importantly, the key for disruptive technologies, as we've studied it, is the expected trajectory in the performance improvement, rather than just where it is today at a static point in time. So here we show you that TV viewership really only grows about 1% annually. And so the figures on the previous slide, when you just extend the lines over the next 5 years at a 1% rate, don't really change that much. But as many of you know, over-the-top services are adding content at a much faster clip than 1% annually. So in other words, over-the-top offerings don't have to replicate all the existing TV content, but just enough to appeal to a portion of the population. So ultimately, we think that OTT services, while not a perfect substitute for pay TV, could become a compelling proposition for modest income homes that watch a below average amount of television. And as the theory goes, this is where the disruption starts. It's not with mainstream consumers, but actually at the fringes, with customers that tend to be the least profitable for incumbents. And as we thought about how realistic this type of trade-down effect could be, we thought it'd be interesting to look at the U.S. television population along two metrics. Number one, household income, and number two, percent of TV viewing. And our hypothesis is that higher income homes are probably not susceptible to cord cutting, since by definition they're less price sensitive. Ironically, below average income homes may also be less susceptible because they actually watch the most amount of TV, so that means that they get the most out of their pay television subscription. The risk, in our view, is actually in the middle income homes of average wealth that actually watch the least amount of TV. As we show you on this graph here, we combine the data for the two variables with a third, which is the percent of the total population by household income, which is the size of the bubbles here. So the group that we suspect that may be most likely to view over-the-top offerings as a low-cost substitute could be as large as 39% of homes. To help further understand the risk of cord cutting and size the potential risk and to quantify it, we recently ran a survey of over 1,000 Americans in our Future Video survey, and our sample has demographics very similar to the overall U.S. Census data. So I just want to share with you a couple of the interesting results. And here on this slide, what we found is that the biggest reason why people don't subscribe to pay TV is because of price, and secondly, because these people are starting to use over-the-top services as a substitute. A couple other interesting things from our survey. First, over-the-top penetration was around 25% in our sample, and about half of that 25% use it as a complement to pay TV, and the other half use it as a substitute. And this is the other thing that I think people get confused about. A lot of people seem to assume that this issue of cord cutting is a black or white issue, that it will either happen or it won't happen. In reality, we think it will be much more shades of gray, with some people choosing OTT as a complement and others using it as a substitute. Looking here, if you further segment down the OTT subscribers in our sample, what we found is that they skew both younger and less affluent, both relative to the general population and relative to those that use OTT as a complement. And this former attribute touches on potentially a bigger problem down the road in the future, which is what we call behaviorally driven cord nevers. So think of these people as tomorrow's householders that are probably in their teens or younger today, that are growing up in an internet-based video culture where, you know, they say things like, why would I pay for television, or I can find that show for free on the web. And when these people ultimately start establishing their own households, some of these consumers may choose internet streaming services because, quite frankly, that's what they've grown up and are used to. So who's most exposed to some of the risks and trends that I just talked about? The conventional wisdom is that a shrinking pay television universe is bad for distributors like DirecTV, Comcast, and Time Warner Cable. It's certainly not good for them, and I'm not going to make the case that it's a plus, but my view here is that there's a real hidden risk, and that hidden risk is that it's potentially very dangerous for cable networks like ESPN, MTV, TNT, Fox News, etc., which account for anywhere between 60% to 100% of the operating income for the major media conglomerates that I cover. The reason, quite simply, is because these cable networks are the ones that have benefited the most from the current pay television ecosystem. So we just lay out for you here a quick snapshot of average or typical cable programming economics. And what you find is that, on average, they have 40% EBITDA margins. Their capex to revenue ratio is 1 to 2%. They convert 50% of their EBITDA into free cash flow, and they have supernormal returns on invested capital. And that's great, and it's a great business today, but obviously for those of you that have been to business school, textbook economics would tell you that that's probably not sustainable over the long run. So if we're right that the pay TV universe continues to shrink, this means that as subscribers decline, what you'll see is that affiliate and advertising revenue will decline also, largely in tandem. And also cash flow will actually decrease at a faster rate because of operating leverage from fixed programming costs, which don't change all that much from year to year. On the positive side, I would say that conglomerates that own film and television studios will benefit from new buyers of their content, but the problem for the stock prices of the conglomerates is that their cable network profit dollars are much bigger, as I described earlier, than studio profit dollars, and also the street applies a higher multiple on cable network cash flow, so the net impact would be negative for the conglomerates. And over time, this could also become somewhat self-reinforcing, because as over-the-top services grow, they will ultimately have more money to spend on content to reinvest in their service, which could perpetuate a cycle. The irony, interestingly, as you think about this, is that cable programmers may actually be the primary reason that the industry is exposed to disruption from internet streaming services in the first place. And I know that the average consumer likes to blame their cable or satellite company for jacking up their bill every year, but if you go a level deeper, cable networks are actually the root cause of this increasingly tenuous consumer value proposition. And the reason is because in their desire to sustain growth, they really focus on two things. Number one, higher affiliate fees to distributors, which are ultimately passed through to the consumer in some shape or form, and also by driving more channels, many of which go unwatched. So I thought I'd conclude before taking questions by addressing some of the more common questions and pushback that we get on our thesis, and we get a lot of that. But first, we're often asked about live viewing and sports like ESPN and RSNs limiting the cord-cutting risk. Leaving aside that there are actually a fair amount of sports that you can get online, like MLB.com or, quite frankly, Sunday Night Football now, and you can also get broadcast sports in HD quality for rabbit ears. We did address this question in our consumer survey that I mentioned earlier. The good news is that what you see here is that 80% of current pay TV customers indicate that they subscribe because of any combination of sports, live viewing, they like having more choices, or they're just not price sensitive. And that's good news, because that means that this 80% probably are not likely to churn off in the foreseeable future. The bad news is that this still leaves about 20% of subscribers at risk. Next, some argue that if things really kind of go the way that we talk about, and things ultimately get bad and the economics of the business come under pressure, media companies will just stop licensing content to the OTT streaming services. I think that's pretty unlikely because the industry may be in a little bit of a prisoner's dilemma. So said another way, while the whole industry may have been better off not enabling streaming services, now that some have, the others may feel pressure to do so as well, so that they're not economically disadvantaged. In addition, those that do have deals with streaming services may find it challenging to reverse course, because this would obviously have a negative financial impact. And ultimately, the way I characterize it is, once you start taking the money, it's very hard to stop. Another question I get is, can't some of these incumbents, either cable networks or pay television distributors, just simply outspend and crush these over-the-top services? To address this, the slide here just shows you that traditional cable networks and pay TV distributors do have much higher EBITDA and free cash flow margins. But herein lies the interesting conundrum and dilemma for incumbents. New entrants, particularly those at the low end of the market, have business models that are designed to survive with substandard profit margins. In turn, established companies look at these type of economics and they treat it as, or they look at the low end of the market as basically too small or with unattractive economics. Alternatively, for incumbents to compete, there's a risk of margin compression. So in contrast, some insurgents like Netflix probably look at the much higher margins of the incumbents actually as potentially very lucrative and, quite frankly, the upside opportunity as they scale their business and move up market over time. So what you find is that incumbents and insurgents have a very asymmetrical view of the market opportunity. So I know to some of you, just to conclude, some of what I presented here may seem a little bit far-fetched, but if we take a step back and maybe reframe things, I don't think it's that outrageous. So the slide here just shows you customer satisfaction among Americans across all industries in the U.S. economy, and this is compiled by the ACSI, which is a third-party organization. And to put this in perspective, paid television customer satisfaction is basically second lowest in the U.S. It's basically in line with the airline industry, and it's actually lower than the U.S. Postal Service, which would seem to suggest that some consumers are open to alternatives. Lastly, the other way I just try to convey my point that a lot is changing very quickly is that the concept of channels in and of itself is already starting to sound a little bit like an anachronism. So I joke that in the future, when I have kids, because I don't have kids today, I'm going to tell them this story. I'm going to say something like, son, back in the old days, to watch a show, we had to tune to a channel, which was associated with a number that we had to input into a device called a remote control, but we had to be there at a certain time in a certain day, and if it wasn't there, it wouldn't be there. It's already starting to sound a little bit weird. So just to conclude, I'd be remiss without including this final slide, which just lays out some of the caveats and some of the things that we think about as we always try and assess and reevaluate our investment viewpoint. I would say the three things that could ultimately prove us wrong are, number one, authentication or TV everywhere. I think this is probably the industry's best chance to adapt because this could ultimately blunt some of the impact that I talked about. Secondly, there's always the possibility that I could be wrong and over-the-top services could just be a complement and not a substitute, as I described. And lastly, this is a broader question, but if consumption-based billing for broadband gains traction, this could obviously reduce the amount of video that's consumed over IP. And so with that, I'll stop, and I'd be happy to take your questions if there are any. That includes broadcast networks. So the question was, the 16 channels watched on average per week per adult, does that include broadcast networks or is that just cable networks? That includes the broadcast networks. Sure. So the question is, in Canada, some of the traditional satellite and cable companies are starting their own streaming services. Is that happening in the U.S.? Yeah, it is in a couple of different shapes or forms, and let me describe some of them to you. So one is what I just talked about, which is the TV Everywhere or authentication initiative, where basically if you are a pay television subscriber at some point in the future, and to a limited degree today, you will have access to your channels on demand on multiple devices for free. Another example of incumbents dabbling in this space is Hulu, which is a joint venture between NBC Universal, News Corp, and Disney, as well as Providence. And then Dish is the other big player in the market. Dish is a satellite company here in the U.S., that's acquired a ton of wireless spectrum, also acquired Blockbuster, and has launched a streaming service. But none of them have seemed to be going head-on with some of the pure play guys because they have different considerations given their legacy businesses. I think one more question.
Alex, thanks so much. I didn't forgive if you had mentioned this, but I was wondering if with the substitution and complement behaviors you had controlled for the economic conditions that we're in, or if you have plans to see how your static results now compare in a year or two. And then the second piece with your middle-income homes and how they tend to be the ones that this seems to be most beneficial for. Did you happen to ask any questions about are these households who had recently lost jobs and that type of thing?
Yeah, so those are two very good questions, and I think both of them, if I may, I think kind of tie together this question of like how much of these issues are cyclical in nature versus secular. And I would say the way, so number one, to answer the first question, no, there's no good way we could find to control for, people who've just lost their jobs or certain economic conditions. But ultimately, I think it's very hard to separate the two issues. In other words, a cyclical impact and a secular impact could actually be intertwined. So in other words, the way I frame it is because people are under some financial duress, could be leading them to try out cheaper alternatives. And actually, that's not all that different than what you saw in the wireline phone business. So if you go back and you study what happened to landline phones, wireless substitution started in, I think, 2001 with the last recession. I can't remember how many recessions we've had since then, but I think it was 2 recessions ago. And what you found was people dropped their landline phone, and a lot of us on Wall Street were like, oh, it's just a cyclical phenomenon. As soon as the economy gets better, they're going to come back, and it'll be fine. And what happened is people substituted wireless in and found it was fine, and wireless services got better over time. So to answer your question, I think it's hard to separate the two, but I understand where you're coming from.
Thanks.
Sure. I mean, broken is such a. Yeah, I think the model is under pressure, and so again, I'm a big student of history. So if we go back in time, back when cable was just starting out, distributors and cable networks were very aligned, and their common enemy was the broadcasters, right? So ultimately, cable distributors needed content to acquire new subscribers. And therefore, new subscriber growth was really good for the cable networks because it grew affiliate revenue and ad revenue. Now what you're finding is, as the industry is maturing, is that they're increasingly at odds. And I think that is the root cause of a lot of these tensions that we talk about, and they manifest themselves in different shapes and forms. One is, as you pointed out, blackout situations with TWC and MSG, for example. That's just the latest situation of that. And also increasingly tenuous discussions over, say, retrans or other affiliate revenues. So all these, I think, speak to the heart of the issue, which is that there is growing tension and that the market's very mature now and people are fighting for a finite amount of dollars. Question in the front over there? Great. So the question is thoughts on companies like Netflix and Hulu actually also producing original content. I think this is a very, very natural evolution for them. Let me say a couple things. One is that for these type of services, I think they will ultimately start to look more and more like HBO over time. Again, being a student of history, having studied how HBO evolved over time, I think ultimately Netflix and Hulu and some of these streaming services will look to differentiate through exclusive content and or original programming. So I think that's a very natural evolution for those services. The second thing is, and I'm going to go a little bit off topic here, but this is probably what we're going to focus our future research on, is if you believe this idea that more and more shows are actually going to debut on-demand services, The other interesting question is how, in the future, are hit shows broken? If we don't all sit down at 8 p.m. on Tuesday night watching a show, well, how does a hit show actually get made? And so here, some of our, and I'm just making this up as I talk, but I think two of the more interesting things that could evolve is, number one, the importance of recommendation engines. That, for example, Netflix has invested a lot in. So, for example, they know that I really like the show Nikita, for example, and therefore, and based on other data that they have, they may be able to put in front of me original programming that may be relevant or pertinent to me. Secondly, I think social could also become hugely important here. And so social is another big theme that we've been studying for the past couple of years. And for the media business, social and that kind of virality that it creates could just really accelerate and actually make hits actually bigger. So I think those are two kind of interesting thoughts to think about. Sorry, I think we have time for one last question. The cable distributors. So, it's hard to say exactly what the game plan is. I think they realize that wireless is a growing, increasingly important product for the end user. But at this stage, I'm not sure that there is a definitive plan in place. I think an interesting idea is to just drive adoption of Wi-Fi as opposed to acquiring new or more wireless spectrum. Great. Well, thank you guys very much for the time. I appreciate it.